If we look back at a number of recessions, I think the dot-com recession is instructive here because there were similarities with these types of assets that were very euphoric, right? The tech sector, especially the unprofitable tech sector, that was clearly a bubble both that time and this time. What made that recession interesting is it was actually a very mild recession by most indicators. So that the 2001, 2002, 2003 period was very soft economically. But you had generally less unemployment than recessions that came before it, and recessions that came after it is one of the more mild ones. So I think it's certainly possible that this could be along those lines, where it's not the gigantic recession that we've been accustomed to in the past, the global financial crisis and the COVID shutdowns. But I mean, there are certainly policymaker choices that could exacerbate it. I mean, if they mismanage how they run the money, because we have a very centrally managed money system, you can certainly cascade into more and more losses. And it's also going to depend on how quickly things like AI can ramp up. But generally, I'm looking less at one of those big deflationary collapse type of recessions, and I'm looking more at a stagflationary type of recession. But we'll as data comes in and as policymaker decisions come in, we can get more clarity on maybe how severe this might turn out. So I think right now, in the next several months, we've been in a disinflationary cycle. I think we're going to continue to be in a disinflationary cycle. Now, in the 70s, for example, you would have inflation come down from a high level to a level that is still pretty high. And so inflation doesn't always go low in recessions. It just always, historically in the U.S. always goes lower. If you look at internationally, if you look at when you see emerging markets have recessions, sometimes they have a massive inflation breakout during recession because their currency works differently, right? Because they have liabilities that they can't print, and therefore they tend to experience different types of recessions. One thing that makes this period interesting is that there are tighter energy constraints now. And so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where, on the demand side, you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They can still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. So again, giving an exact number is partially depending on human policymakers. But the way I would phrase it is that the constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removed some money that was printed, but only a small portion of it. Most of the money that was printed is still out there. We still have not had really a capex cycle in energy or commodities. We've not brought new copper mines online at scale. We've not brought new oil fields online at scale. We're seeing some obviously development around LNG export capacity to, for example, reduce Europe's reliance on, now that they've been severed from Russia, they need more LNG. So obviously there's work being done, but I think the world is still relatively tight on the supply side. And so if you see China really ramp up and fully reopen in terms of international flights and things like that, and if you see, just general more economic activity throughout the world, you could certainly have an environment where oil is back over $100, for example, while you have economic softness. I mean, if you look at 2008, for example, oil was spiking kind of at the early stages of that recession. It was actually in some ways contributing to that recession. And so the timing doesn't always work out the way we expect. So the way I look at it is that if we're willing to go into a recession, we can certainly get inflation down for periods of time. And the question is, when we try to accelerate out of that recession, when we try to have another growth cycle, I think the problem is that inflation, the conditions are still there to reignite another inflation wave. So inflation came in waves in the 70s, it came in waves in the 40s, And I think it's going to come in waves in the 2020s. Even if I wouldn't try to predict the exact lows and the highs, I'm more trying to, look at the conditions and expect the direction. Recessions, as you point out, are normal. It's normal for periods of excess to get wiped out, to take out businesses that are not really being productive. That frees people up, frees resources up to go do something more productive, figure out something new. And so that's completely normal. It also, wipes out bad debt from the system. The problem is that everything is so over levered now. And more importantly, leverage has gone up to the sovereign level. So what made 2008, for example, such a deep recession is that you had built up private sector debt for decades, and then that rolled over. A lot of that was then put onto the sovereign level. Basically, we somewhat delever the private sector. We put a lot of it onto the public sector. The problem now is that a lot of it's already on the public sector, and that tends to be a more inflationary scenario because they're still running. If you picture 2008, they were doing these like large rescue packages that were like $700 billion, whereas in the current environment, the deficits are like double that going forward on an annual basis. I mean, it's like the baseline deficit now is like 1.5 trillion. And to the extent that the Fed is eventually forced to resume monetizing it, which we might have partially seen over the past month with, they're still doing quantitative tightening, but now they're actually adding more liquidity into the system than they're taking out. And so if you get back to a period of monetized large fiscal deficits of that scale, in some ways that's like a stimulus. But the problem is that it's an inflationary stimulus. And so on one hand, you have contractions in, I am concerned about commercial real estate. I would not really want to be working in, a fund that finances office space, for example. I wouldn't want to be in an unprofitable tech company. There are certain areas that I think are quite vulnerable. But when you zoom out, that's somewhat balanced by the fact that they're just doing these ongoing deficits that are just pouring more money into the economy. And so that's why I think it's a more stagflationary type recession. I think if you work in travel, I think if you work in, if you're a welder, if you're a plumber, I mean, a lot of these people are now making really good salaries because they're still in short supply and they're somewhat recession resistant. So I really think that the severity of the recession is going to depend on the type of work you do, your role in the economy, and what type of assets you own. But in general, I expect it to be a more stagflationary type of recession, and one where inflation's ready to return as soon as policymakers are willing to try to get us out of that recession. So my base case is that the 2020s decade will not be a good one for equities, especially in inflation-adjusted terms. It's not necessarily that I'm expecting crashes, although they're certainly possible. It's more like when we're looking back from the late 2020s or we're looking back from 2030. I just think it's not going to be a very good decade. And of course, how volatile it is will partially depend on all sorts of policymaker decisions. But if we zoom out, ever since the 1980s, we've had this period of lower interest rates and higher equity valuations. And because if you're comparing how much you'd pay for an equity to a 10% yielding treasury bond, right? You're not willing to pay much for that equity because you're taking on a lot of risk and volatility, and you can get a 10% yield on the treasury. So you're going to pay a very low multiple for that equity. You're going to get a very high, say, dividend yield, earnings yield, in order to compensate for that risk. But when the treasuries came down all the way to like sub 1%, people were willing to pay almost anything for an equity. Because it's still, has better forward return prospects than a super low yielding treasury. But now that we're kind of in a regime where treasuries and interest rates have really hit the floor, and now they're in this more sideways to up type of environment, that takes out, I think, that tailwind of ever higher equity valuations. And so they're more going to trade in line with their earnings. And so I certainly think you can see a period where, especially in inflation-adjusted terms, the major large cap indices just kind of chop around in a band for 5+ years, which is quite common, unfortunately, among global equity markets. The U.S. has been kind of an exception for the past 40 years. We've had among the strongest markets, but I think that trend is probably over, and now we're looking at more. It depends on the stock you're in, depends on the sector you're in. But I think that the big indices are not in great shape. And another factor is that You can look at all these valuation metrics, but one of my favorite ones is to look at household allocation to different types of assets. And when the stock market peaked in late 2021, U.S. households had a record percentage of their assets in equities. And so there really wasn't a lot of marginal capital available to come in. And then when you look globally, countries had basically, both investors in the U.S. and investors outside of the U.S. were kind of like max overweight the U.S. And so we really have all got on one side of the boat. And so I think now that has some degree of time to unwind. And that's part of my thesis on why we're not going to probably see good equity returns in the U.S. for the next 5+ years.